Buckle up, investors. Today, we're reviewing one of IBD founder William O'Neill's most important trades. Not only did this trade help him solidify key trading rules we still put into practice today, but it was also on the heels of one of the most transformative medical advancements of the 20th century. So strap in and let's get to it. I'm Rachel Fox, and this is Model Book Stock Review, where I'll be taking you back in time through a series of historic trades made by IBD founder and author of How to Make Money in Stocks, William O'Neill. Studying past precedents to understand what winning trades of the past looked like should be a fundamental part of any investor's process. Today, we're traveling back in time all the way to the 1960s to birth control maker Syntex. For this trade, I spoke with IBD's David Saito Chung, Deputy Markets Editor, whose tenure at IBD extends back over 25 years.
It is one of the most incredible examples of how Bill became very successful in growth stocks. There are so many lessons to be learned from his trade and his investment in Syntex.
According to Dave, this wasn't even O'Neill's own idea to start with. He actually got the idea for the stock from another person, but followed through by doing his own research. It goes to show it doesn't matter where the idea originates from, as long as you do the research using your own developed set of skills as an investor to vet it. It was in doing this research that O'Neill realized he could be onto something big.
One of the major takeaways I think he received was that not only was Syntex a truly innovative biotech, if you will, it invented the birth control pill and was the first company to successfully market this revolutionary product. But the company, before he even bought the stock, had quarter after quarter of amazing earnings per share growth. In fact, according to the article, back in the third quarter of 1962, Syntex recorded a 400% increase year over year in earnings per share. And then in the December quarter of that same year, 1962, profits went up 800%, then 400% in Q1 of 1963, 300% in June 1963, and then 300% growth in the third quarter. So all of this was happening as he was doing research, and then initially made his buy basically in the third quarter of 1963.
An important thing to note on this trade is the initial buy point. O'Neill didn't buy it at the very bottom. He didn't even pick up shares as it moved past an early entry point at $17 a share on a split-adjusted basis. It wasn't until the stock had already shown a significant gain that O'Neill finally got in.
In fact, when the stock had already gained more than fourfold, he was looking for a unique pattern called the high tide flag. These high tide flags are very rare. They usually only happen once, if not twice, during a bull market cycle. Bill put this pattern on the map for individual investors.
Here's how this key pattern works. First, you have a run-up of at least 100% in a given stock over a period of 4 to 8 weeks, which is exactly what Syntex did. Then the stock pulls back in a very calm and measured way. In the case of Syntex, it fell 21% to 22% from its split-adjusted high of around $33 per share. That happened over a period of 3 to 4 weeks. That produced the flag portion of the high tide flag. But it wasn't just this rare, powerful pattern that caught O'Neill's attention. There was another important feature regarding the stock's price that made this buy point ripe for the taking.
When he bought it, actually before the 3-for-1 split, the stock actually was trading right around 100, and that's a very important piece of information to have. This goes back to the wisdom and insights brought by Jesse Livermore, the legendary trader in the early 20th century, where he spotted stocks that made major moves when they crossed big price levels or key price levels like 100 or 200 or 300. So when Bill O'Neill spotted Syntex breaking out of this high tide flag at 100, he pounced on it. And then that was the start of that big 450% gain.
Another key part of this trade is how it helped O'Neill solidify the now standard 8-week hold rule that we use in our trading practice. If you're not familiar with the 8-week hold rule, it's triggered when a stock breaks out past a proper buy point, then rises 20% or more from that entry in 1, 2, or 3 weeks. When this happens, the rule is don't sell. Instead, try to hold it for at least 8 weeks. Prior to Syntex, O'Neill had a tricky experience with another company called Certainteed, where he was shaken out too soon.
He had an experience with another hot, high-flying stock called Certainteed, which was not in the birth control industry, but was actually a roofing products company. Nonetheless, Certainteed was a fantastic winner that shook him out midway through the run. He wanted to learn from that experience, and therefore, when he found the price action and the stock chart move in Syntex, he used the experience of Certainteed as a stock precedent that would help him achieve an amazing 450% gain in 6 months in Syntex. After that breakout, it had 3 big up weeks and then pulled back really sharply on the 4th week of its advance. According to the column that he wrote, it was a 14% decline. And in a similar kind of action with Certainteed, he got shaken out. Well, this time he did not, because he used that prior stock leader as a precedent and held on.
Basically, if you have a company that's as special as something like Syntex, you'll want to use this rule. And when I say special, I mean in terms of company products, growth, its impact on society, that kind of thing. Once it breaks out and rallies over a period of 1, 2, or 3 weeks, you should try as best as possible to hold it for at least 8 weeks. That's exactly what O'Neill did, even though his position suffered a 14% decline on week 4 of his holding. But that pullback turned out to be temporary, and the stock was still trading well above its sharply rising 10-week moving average.
Week number 5, stock rallied, didn't quite hit a new high. Week 6, it also sold off, but finished in the upper half of its range, which indicated that there were large investors coming in to buy stock on the pullback. And so he stuck with it. And then on week 7, the stock roared to new highs with a big weekly gain and fulfilled that likelihood that he could hold the stock for a longer gain.
Ultimately, the stock made another rebound off the 10-week moving average after selling off. That happened several months after he bought it. There was the first touch of the 10-week moving average around November of that year, and that was a good opportunity to add shares to the already winning position. At that point, the stock was up about 100% on a split-adjusted basis. The breakout was at 33 from that high-tight flag, and when it pushed off from that 10-week moving average, it was trading around $64, $65 a share. The next key lesson from Syntex was how the surrounding market conditions affected the trade.
Now, I want to talk about how the stock was making its move. This didn't happen in a vacuum. In other words, you really want to make sure that the stock market is in your favor and providing a tailwind and not a headwind when you're picking stocks like this. And, you know, in the article, Bill O'Neill highlighted that before the stock actually made its 2 buy points, one out of this deep base and 2 out of the high-tie flag, there was a market follow-through by the S&P 500 on October 29th, 1962, several months before the Syntex had bottomed out, started forming the right side of that deep cup. And then I'm going to say several weeks after that high-tie flag breakout, there was another follow-through on July 30th, 1963.
The main point here is that you really want to take action when the market is in rally mode. When we get follow-through action on the indexes and see other stocks making new highs, posting breakouts, and trading tightly during pullbacks, those factors all help increase the potential for success within our investments. The final key aspect of this trade I examined with Dave was the sell signal.
Now, looking at the top of the market, that happened when the stock was trading at 190. There was a climax top. Stock had gone up, let's see, 6 or 7 out of the last 8 weeks. It hit 190 on a split adjusted basis, which meant that it was trading around 570 after breaking out at $100, which is when O'Neill bought the stock. So, more than a 450% gain, essentially. But on that week that it topped, there was stalling action. even though it hit new highs and volume was pretty good in the week prior to that, volume actually fell versus the prior week, and the stock finished pretty much at around the middle of its weekly range.
That was a sign that some savvy investors who bought early into the move were now dumping shares and distributing the stock to other investors who were buying way too late. So, that climbback's top combined with lower volume on that final week when the stock hit new highs, plus the pullback off the ultimate peak, gave a clear signal that the character of the stock was indeed changing.
IBD never really talks about selling stocks based on tax rules. One of the most interesting things about this stock example is that when O'Neill sold it, it was exactly 6 months and 1 day after he bought it. And that made a big difference in terms of the capital gains tax. At the time in the 60s, capital gains were as high as 90%. But if you waited for a long-term capital gain, which was defined as holding a stock for at least 6 months plus 1 day, then you would have had to pay less tax. Now we have obviously a 12-month rule for long-term capital gains.
Syntex is no longer an available stock to trade, as the company was acquired by Roche in May 1994. After the acquisition closed, Roche downsized Syntex's research and development facilities and eventually shut down the firm entirely in September of 2008. It serves as yet another great example of what can happen when we catch these significant generation-defining investments early and invest in them at the start of their growth journeys. Many of us will even be users of these products and services, but few will stop to think about looking further into the fundamentals and technicals of these stocks to see if they're truly worth investing in. Remember, if you want to succeed as an investor, never forget to look both forwards and backwards in time.